Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. How was your week? I trust it was spectacular. There's certainly some good upside in the equity market has continued to rally. That rally is looking a little bit tired. I did think we'd get a rally at the start of the week, but it has been stronger than I thought it would. But nevertheless, it's looking a little bit tired. And the fundamental economic headwinds are exactly as we have been forecasting. We've now seen headline inflation CPI in the United States reaccelerate, just small, but reaccelerate, not still falling. And we've seen overnight in New York, in the US, the PC indicator really did reaccelerate as well on above market expectations. So 4.2% from 4.1, it's not much. On the month, it's on the year. On the monthly data, it was up 0.2. Now that's not an outlandish level for the PC on a monthly basis. It is, however, top of the comfort range for the Federal Reserve. It prefers to see a number between 0 and 0.2, so to constantly be getting 0.2s at the top of the range with the through year reaccelerating is a definite concern, and the Federal Reserve can see energy prices skyrocketing, and we've been telling you that would happen. So oil continues to climb quite aggressively. We've been getting that one right, and our forecast on gold's proved quite spectacular, actually, quite shiny. So my favorites for the moment remain oil and gold. Gold looks like it could have a little consolidation as oil takes over, if you like, the enthusiasm to the upside of the moment. But both these markets will remain volatile, and you have to be careful about that in your trading, and you can't take too big positions because these markets can swing in a big way and then totally reverse again. They are, after all, commodity markets, so anything can happen. Overall, though, the other data we've seen in Europe with inflation there reaccelerating or flatlining when everyone thought it would keep falling, it's flatlining around 5.2, 5.3%. I expect it to bounce around in that area quite a bit. But again, that will keep the ECB raising rates even as their economy stumbles. And, Sweden, I think it is, just came out with a negative GDP number. And I believe Germany's still in recession, 3 quarters now, 2 negative quarters and a 0 quarter. That's not a return to growth. So the outlook, Italy's in contraction. The outlook for Europe, apart from Spain, looks stronger than the rest. I must say, the Spanish seem to be doing a better job at the moment with their economy. We'll see how that continues to travel forward. But overall, Europe does look lackluster to very negative. Unemployment levels have started to go back up again. They're at good levels, but they're either flatlining in different countries or they've turned a corner and started to move higher again. We saw a Kaizen indicator out of China today for the manufacturing PMI. Just be aware with that data, it's a very small survey. I mean, the official MBS data covers over 4,000 organizations, companies, and the Kaizen, it's about 400, and it doesn't include any of the largest manufacturers, the state-run manufacturers. So it's a very sort of jump around guide. It's just bounced from 49 to 51. It's probably flatlining at 50, that data, but the MBS data, the official China data, is the more reliable one, covering the full gambit of Chinese manufacturing, and that continues to point to contraction. So some small parts of the manufacturing industry may at best be flatlining, but overall manufacturing in China remains in deep recession. I don't think there's any doubt about that. And things continue to deteriorate in China with bankruptcies seriously on the rise. Youth unemployment so bad they're not publishing the data anymore. I estimate it's at least 1 in 4 in terms of youth unemployment at the moment, and that's very worrying from a social perspective as well as an economic future perspective. I believe China is having the big correction to the big economic miracle boom. That's going to be difficult for any set of authorities anywhere in the world to manage, and the Chinese will of course be doing their best, but I hope they start to see this as that stand back big picture event that it is, and this should get them taking more significant steps. I think PBOC should be really slashing interest rates far more aggressively than it is, and it has been over the last decade or two the world's best central bank. So it's not often I get to criticize PBOC, but if I were them, I'd be trying to get ahead of this, because because there's no sign yet of a soft landing for the Chinese economy. And if you take it into perspective, as I've just suggested, from the very long-term historical tectonic plate shift perspective, then they really need to move ahead of this, because the mass of movement, the momentum force to the downside in the Chinese economy could be quite severe. Over in the United States, there's not going to be any policy response with inflation rekindling for any slowdown that we're expecting there, and I am still expecting further decay of the US economy. This leaves equity markets a little bit exposed as they keep getting euphoric on bad economic data again. We're back to that. If the economic data is bad, that means the Fed won't hike, so that's good news for the equity market. Of course, lots and lots of money piles into fund managers' desks every month. They have to buy something, so of course they'll always be buying some equities, and that kind of interest in the market is supporting it for now. But I continue to highlight, I don't mind highlighting it, and I'm even wrong, but I will have done you a favor if I highlight that if the market begins to fold back in on itself, and I've said this a few times in the past, and when it's happened, it has been a significant move to the downside. If the market begins to fold back in on itself this Friday, then I would be, looking next week at, is this something still bigger than what we've already seen? And we've already seen significant downside in the equity market in the US, and this is still a very modest bounce actually to that recent downside. So also, everyone's saying, oh, key jobs data out tonight. It's nothing key about it. It's like one of the most useless lagging economic indicators that doesn't tell us anything about the future of the US economy. It lags the US economy by 18 months. So what's the point? People say, oh, it'll influence the Fed, but I think the Fed knows what I just said as well, because it's very common knowledge among economists. But of course, it will be beat up as a very big thing, and there could be some volatility on the release of that data. If we make new lows below yesterday's lows, Thursday's lows, I think, and close below Thursday's low, I think that could be a warning note for the following week. Otherwise, though, the bulls seem to be having the run of the day for the moment. I hope that helps. Have a great weekend. Clifford Bennett.